can't respond to me. But the question is cost of insurance charges, what are they based on? In other words, if a consumer puts in this amount of money and it grows year after year after year, the cash value grows, but the death benefit is this over, whatever, the 50-year life of the policy. What are the cost of insurance charges or cost of insurance factors based on? Is it based on the death benefit, in my previous example, $250,000, or is it based on the difference between the death benefit and the cash value? It's based on the net amount at risk, the NAR. In other words, the difference between the death benefit and the cash value, right? This is why you can minimize the expenses if you have this line, the cash value, as close to the death benefit as possible, right? Many consumers that don't know the business real well may say, why would I want to maximum fund a life insurance policy? Why would I want to overfund an insurance policy? Well, what overfunding or maximum funding does is relative to this, it gets that line closer to the death benefit, right? Now, that can be a negative. Why? Because the death benefit leverage per dollar of premium is not as much as, say, this bottom line, but it can also be a positive in that the expense drag, those cost of insurance charges, are less relative to this. Why? Because those two lines are closer. Why do you want that expense drag to be very little? Because maybe your intention is 20 years from now to turn on that, to make that death benefit secondary to taking money from the policy or taking loans against the policy in order to fund your retirement, in order to fund college, in order to fund whatever it is. There are vast amounts of books. Be your own banker, to where you can that talk about how to leverage these contracts, take money out of the contracts, not take money out of the contracts, but rather take loans in which the policies are used as collateral. By the way, over 80% of the index universal life insurance business is for the purpose of accumulation. In other words, for the purpose of putting in as much premium as possible in order to get as little death benefit as possible. Why the heck would we want to do that? Well, again, because it minimizes the cost of insurance charges. The other 20 or so percent are effectively for the purposes of put in as little of premium as possible to get as much death benefit as possible. Kind of the term insurance type play, right? You want the absolute cheapest death benefit coverage that there is. So over 80% is for the purposes of max funding. By the way, VUL versus IUL. Variable universal life insurance will have an additional charge, and that additional charge would be money management charges, right? Whether it's T. Rowe Price or whether it's American Funds or whoever, a sub-account within that particular policy. Yes, you'll have these three charges, but you may also have a money management charge in there. Now, it doesn't mean that VUL is going to be more expensive versus this particular index universal life insurance, for instance. It just means that there is an additional layer of charges. And by the way, there may be an additional layer of charges versus what I'm showing you here with an index universal life insurance. Something that has proliferated over the last 10 years or so is cash value charges or charges on the account value charges. So there may be a fourth category here, which is probably a minority still. That is, okay, even within indexed universal life insurance, there is, say, a 50 basis point charge on whatever that cash value does over that period of time. So you can have that fourth category there, but I talk about the big three because that's a generality. That is what 99.999% of universal life insurance policies have across the country. What about whole life insurance? Do whole life insurance companies price in acquisition charges into their policies? Do they price in admin charges, administration charges into their policies? Do they price in cost of insurance charges into their policies? The answer to that question is yes, they do. It's just that with whole life insurance products, you're typically paying a heck of a lot more for the premium in order to get guarantees and also in order to get dividends, right? So with cost of insurance charges within whole life policies, many times you're paying a heck of a lot more in those cost of insurance charges by putting in more premium, but that overcharge that you are paying for is returned to the consumer in the form of what? In the form of a dividend, right? So my point is whether it's universal life insurance, whole life insurance, all insurance companies price these charges into the policies, and all of these products are wonderful, right? I'm a big fan of whole life. I'm a big fan of VUL. I'm a big fan of IUL. It's just a matter of where you sit on the risk spectrum. For instance, whole life insurance may be for somebody that's very conservative. Indexed universal life insurance may be for somebody that is not as aggressive as VUL, but not as conservative as whole life. Variable universal life insurance, obviously that's a little more aggressive, because with VUL, your cash value could look something like this and then drop down. And by the way, when your cash value drops, what does that do to the net amount at risk and thus the cost of insurance charges? It increases those. So kind of a double whammy. You have less cash value in there to support the policy, while at the same time, your expenses have increased, right? And by the way, the option 1 versus option 2 death benefit, the whole reasoning behind why you would choose an option 2 over an option 1, but then option 2 levelizing to an option 1, is this, that optimization thing, that Ferrari mechanic tuning in that vehicle, that life insurance vehicle, right? So those are the big 3 of universal life insurance expenses. In short, basically all of these expenses, for the most part, can change. Premium loads, many times the current premium load being charged is less than the guaranteed premium load being charged. Guaranteed being the maximum that the insurance company has in the contract. So read your contract. Per thousand charges, many times those per thousand charges are less than what the maximum is that can be charged. Cost of insurance charges. Cost of insurance charges on universal life insurance can be, the maximum of cost of insurance charges are governed by CSO mortality tables. For instance, many insurance carriers have to have currently the 2001 CSO mortality table as a maximum charge, which, by the way, that's turning into the 2017 CSO mortality table, which insurance companies have to switch over to by the end of 2019. So if you're an agent, if you're an insurance company executive, you probably, well, certainly if you're an executive, you know about all this stuff already. But that is a maximum charge an insurance company can charge with that universal life insurance. Many times the life insurance company is charging maybe 40, 50, 60% of the policy, right? Just understand that those COI charges can increase up to a max of that. Now, it is regulated how those insurance companies can increase their charges. For instance, the mortality exposure of the company has to go up, for instance. An additional one is interest rates, the expectation of long-term interest rates. If it's lower than what the insurance company had originally priced the products at, then they can increase the cost of insurance charges, because insurance companies, they invest the client's premium in investments, right? So interest rates can also affect cost of insurance charges, and that actually has affected a lot of insurance companies here recently, you know, and what they do with their COI charges there. So that's pretty heavily regulated, but in short, all of these can be adjusted. It's just that the difference between this and whole life insurance is that whole life insurance effectively charges the maximum, to speak generally, effectively charges the maximum. It doesn't mean that that life insurance contract is bad. Doesn't mean whole life is bad. Why? Because those whole life companies, they refund back the overcharging to the consumer after they know what their mortality experience was for the year, for instance, after they know what their administration charges were for the year, for instance, after they know what their acquisition charges were for the year, for instance, after they know what their investment returns were for the year, for instance. Really, 3 primary things within that dividend calculation. They return that overcharging back to the consumer, and that is the difference between whole life and indexed universal life insurance. I hope that makes sense. It's not that one charges a consumer more expenses than the other. It's just a different way of calculating it. I hope this makes sense. If you have any questions, please comment below. If you like this video, feel free to like, send it on to a friend. But thank you for your time, and I look forward to talking with you next week.